Yes, sir.
And we're live. Welcome to Clutch Trading.
I didn't even know your voice could do that. That is amazing.
That's my radio announcement. Work on it.
Oh, this is Gucci. Um, boom. I'll just make the announcement known. How's everyone day going so far? Gonna wait for some peeps to get in.
We're just busy.
Oh yeah, man. Just gonna hang out a little bit till peeps get in, cause we early, but I have to be early.
Sold to 69. That's what I'm saying.
No,
End of the
I'm
month.
gonna, I'm gonna.
End of the month.
You'll watch this recording and you'll know why.
You're gonna tell
Cause I
me.
know you
You're
ain't gonna be in here.
tell me. I think Soul's not going to 16.
No.
If I had money, I'd bet you.
I'd win. I would gladly take your money.
Well, I don't make bets that I wouldn't. But Soul's going to 16. Heard it from me.
All right, Denix is our new resident TA. I'll resign.
My source. Trust me, bro.
That's a pretty good source.
Good source.
Glad you see the rates continuing to hike up throughout the year.
Yeah, I mean they're gonna have their peak. I'll post that chart in just a sec. Boom. All right, so we over her. All right, let's go to bond yields. Take a look at that 30-year. Ooh, that's a nice dump. That's perfect. So I mean, I think rates are going to top out here. Like just a guess, because I mean, we broke this 123.6% extension, and
Okay.
just so y'all know where the hell it came from. I mean, I just took it from wave 3 to wave 4. So I mean, wave 5 should top out around here. But I mean, we'll go over this in today's lesson. You heard.
That was good.
I mean, we can measure it from the previous measured move. That's an anomaly. But I mean, if you took it from like the end of where this imbalance took place, and like this is the swing pivot high, we went down to the swing pivot low. We'll just slap some fibs on there, and y'all could see the trend line. I mean, I measured it from this high to this bottom. So I mean, interest rates, the wave could complete up here, but I do like to get a little bit more minuscule reading and measure, like, see where these dots are at the peak of wave 3 and the bottom of wave 4. So I've got like this 123.6% extension and this 161.8. So I mean, wave 5 can finish anywhere from here to here. And since wave 3 was a 223.6% extension, which does not happen very often, that I was thinking that wave 5 would get at least like maybe half of that move. But the real kicker is the bond yield inversion. I mean, this isn't the class per se, but I mean, this is the 0 point, meaning if the 2-year and the 10-year bond were put on a chart together, this is their inversion. So the 2 years trading at 2.886 and the 10 years trading at 2.588. This number is supposed to be less than this number because that's showing that short-term debt is more expensive to borrow versus long-term debt, which means creditors and people who are issuing those notes are uh, more inclined to be taking shorter notes because they're saying that their yield for return is going to be more profitable here versus long term, which is terrifying. Like you don't want short term debt to be more expensive than long term debt because that's a telltale sign that creditors and people who are issuing those, like, warehouse banks are nervous about the longer term picture and feel better about the shorter term picture. And so whenever these
Everyone should be
bonds,
worried about the longer term picture right now.
of course, I
With
mean,
what the
like this,
bricks are doing, it's scaring the shit out of me with this new like reserve currency they're building. I mean, that's honestly like the number one thing.
uh,
Like,
is terrifying. I mean, this is where we had one bond yield inversion, and then we cranked. COVID happened. Um, and this is when 2007 happened. Y'all know what happened in 2009, which is like right around here. I mean, the bonds don't tell the picture of like how the economy is really doing. It's showing how confident big money is feeling. And so whenever these bond yields get below the 0 point, I mean, 2000, like we had that internet bubble. 2007, we had '09, the housing crisis. Over here, 2019, like we had COVID, economy shutdown. So I mean, these are like underliers to like keep in mind of like it'll kind of predate like maybe a year, like 6 months to a year, maybe even 2 years of events that are about to happen in the economy, and they'll just tell you what's happening. I mean,
hmm
whenever we go below the 0 point, bad shit happens.
yeah.
All right. So yeah, rates, you know 30-year. Oh no, sorry, gotta hit Control Z, get my 3 back. There we go. I mean, we're not going to go higher than this. Like, that's just not going to happen. We could top out here because like on a weekly time frame, we never broke above. So I mean, that's still bullish because that's where this micro count is coming from. But whenever we invalidate it, I'm just like, like this fib's invalid. Like this has got to go a little bit higher to hit a new fib. And that's what we're going to be going over today. So I mean, you guys voted. Y'all wanted to see a little bit of Elliott wave. And so to break it down, um, we're just gonna scroll a little bit. I mean, this is like the principles. Like I'm gonna post this in Clutch Trades right now, and I've posted it numerous times, but I'm just gonna be putting it in here. So if you guys want to read along at a different pace or just have that, I mean, feel free to just bookmark it. I constantly have this bookmarked. I mean, bottom line, Elliott wave theory is named after Ralph Nelson Elliott. He's the guy who created it. He saw that there was a correlation in the markets where investors and big money had, motive waves and corrective waves based on people's emotions on how they were feeling about the market. And so he created what is known as the Elliott wave theory. It's been around since the 1930s. Like, it is a very, very old method of predicting and mapping where the market can be going, where it should be going, and where markets can end and correct. So so Elliott wave is broken down into patterns. So there's a motive wave and a corrective wave. And so motive waves are a count of 1, 2, 3, 4, and 5. This is where the motive, oh, it did not work. This is where the motive wave and impulse wave is taking place. There's a clear sign of trend, there's a clear sign of cheering. So you can think of impulse waves as it's very undeniable that the bulk majority of investors are investing in the market, and they're investing in the market heavily. There's an influx of demand. There's a clear sign of trend that the chart is moving in an upward pattern. And you can predict where these price points and these pivots are going to take place. In order to have let's just say that this is a macro count, let's just say this is 0 and this is like 5,000. You need to have like these minor counts. So a wave one will have a 1, 2, 3, 4, 5 count within it to make it a macro wave one. So you could zoom in on smaller time frames, like an hour, a 4 hour, a daily, and you'll be able to see this count happening. And there's rules to it, and we're going to go over that. But at the end of a impulse wave is going to follow a corrective wave. And so impulse waves, they're numerical: 1, 2, 3, 4, 5. Corrective waves, this one in particular is a zigzag corrective wave. There's numerous ones. It is counted in an ABC pattern. No D, just ABC. And since this corrective wave can now be constituted as a new impulsive wave because the direction is now going to be impulsively going down, there's a 1, 2, 3, 4, 5 count to make A. And to pivot back really quick, I missed something. So the greater impulse waves on a motive wave is a 1, 3, and 5. But you'll notice that there's a 2 and a 4 count. The 1, 3, and 5 are going to be counted 1, 2, 3, 4, 5. But a 2 and a 4 can be counted as an A, B, C count. And so when this motive wave is completed, we're going into a larger A, B, C count. But since it's now going to be a impulse wave going to the downside as corrective, we're going to be counting A as 1, 2, 3, 4, 5 down, and A, B, C is going to be up because this is now the corrective move within the impulsive corrective wave. It sounds a little confusing, but we're definitely going to be diving into it into a bit more detail. Um, so for example, they're going to give you a really good summary of everything I just went over here. So do feel free to hop in there, read that. Some people are more visual, some people are more book smarts when it comes to learning things. So I highly encourage you guys to read this entire thing if you truly want to learn it. There's degrees to waves, as I mentioned. Like we'll just call this, we'll say this is a grand super cycle, meaning the entirety of it. There's grand super cycles, cycle, primary, intermediate, minor, uh, minute, because I know this is minute. It could be minute, and then this is just a smaller one, and then a sub-minute. I mean, you can change the coloring on these to, make it a little bit prettier of a picture for you to kind of, wrap your mind around exactly like what kind of counts we're in. Like for example, on BTC's chart, if I go to the like this type of view, we're just looking at the daily view. We have all the way back here our, my God, let me just go to a weekly. Let's just fit this all on one picture. So I mean, this is when crypto kind of was adopted, put on Coinbase, for example, was all the way back in 2014 before it was Coinbase. So, I mean, this is the end of the first impulse wave, and then this is our bear market that took place from the beginning of like 2018. Let's call it the end of 2017, all the way down to 2018, and we have a new impulse wave. And so there's like a clear 1, 2, 3 count. You'll notice that these are circled because I'm trying to make it more apparent that this is a grand super cycle or a super cycle count. But when I go to the daily view on this wave 3, for example, you see that I was counting these 1, 2, 3, 4 intermediate patterns. Um, this is just a bit of a bigger vision of how there's wave degrees. If you look at on a weekly chart, you're going to have a larger time frame. If you're looking on a daily, you're going to be having more of a primary count. If you're looking on a 4 hour, you're going to be having more of an intermediate or a minor count. But if you're looking on an hourly or a 15-minute, God forbid, you're looking at like minute counts, like much smaller ones. Um, and so the reason why this works is you guys have noticed that masses tend to invest and divest in the market almost around the same time. And I'm sure you guys noticed when NFTs and crypto was skyrocketing, we were well into our wave 3 count, meaning my own mother brought up Bitcoin investing to me on this, like within this range, like right around here. And that was a bad sign. Like, this is where it's that old added saying where if your shoe shine boy starts to talk to you about what stocks to invest to, it's time to get out. And that typically happens in wave 3 cycles or wave 5 because there's all this new money that's coming into the market, but big investors are using that liquidity as an opportunity to exit. And so that's how these cycles happen. It's masses investing into the markets at the same time and getting caught holding a bag at the same time. um, you guys probably hear about AI trading or bot trading and things like that. They use this model. I mean, a lot of them use algorithmic trading, which is going to be based on, calculated projections. Well, how do they get those projections? How do they get those numbers? I mean, it comes from measuring, like we'll just use Sol as an example. I mean, they're using Fibonacci retracements. They're using Elliott wave counts to figure out exactly where these pivots are going to be happening. So when we hit a 50% retracement from a previous measured move, there's bots and algorithms that are triggered to start, hitting buy orders. When we hit an 88.6% extension to the top of a measured move, they're using that as a signal to exit. So these measured moves and how these waves happen in the market, it's all algorithmic. And also just people use this method manually as well. I know a lot of good traders that use these types of things to time when they're going to be getting into their investments and time when they're going to be getting out. So it's a very old, tried and true method. It's been around since the 1930s. In order for Elliott wave to work, I mean, we have to use Fibonacci retracements. We have to use Fibonacci extensions as well, because all of these have rules. We'll go to a more clear one here on like a wave 5 count, that all of these were pivoting at like 50, 50, 61, 61.8, 161.8, 161.8, and a minor 123.6. This is on an hourly, so it's a smaller time frame, so we're able to see these a bit more clearly. But I mean, you can't deny like how well this system works. I mean, it times every swing high pivot, every swing low pivot. Fibs are undeniable, and using Elliott wave in conjunction with that, with supply and demand, is a fantastic way to increase your edge and enhance your odds within any given market. And so we went over fibs on our last lesson. So if you're not familiar, do feel free to tune in and watch that recording. I went over a bit different method for percentages because sadly, even though this site is really good, these are inaccurate to me. Like these aren't the retracements or extensions that the market typically follows. Like it's 23.6, 38.2, 50% technically isn't a fib retracement, but it's just a common one where we see pivots happening, and it should be 61.8, 78.6, and 88.6. So they're not 100% accurate on this, but there is a relation between the two. So the relationship between Fibonacci and Elliott wave theory. And this is where you guys are always asking, like, well, how, like, where can this pivot? Like, where should we be seeing things? Well, a lot of it comes from this site. Wave two is typically a 50% to a 61.8%, or all, you get it. Wave two is typically a 50% retracement all the way to an 88.6% retracement of wave one. And so if we look at this example over here, let's find, so here we have where the corrective wave ended, and this is where wave one began. We broke previous pivot highs, and we retraced at around 78.6% percent retracement. And if you put this on a 4 hour, we actually wicked below this level and closed above. That each candle, each view you pick kind of has different ways of showing how the fibs work. But if we measured from the peak of wave one, which I'll just put this on here really quick so you can see it. Oh, not that. So sorry. We're going to slap this guy on there. So this is the 0 point for wave one, and this is where the bottom of the move took place down here at this wick, because this is the lowest low and this is the high. This is where wave one was created. And so this is giving us a measurement of where wave two is going to end. And this is what was interesting is wave three was only 88.6% extension, and wave three is typically 161.8%. So that lets me to believe. Oh, do you have a question?
No, my bad. My bad. I didn't even realize my mic was.
You're all good, brother. So even though this could be constituted as a 1, 2, 3, 4, and a 5 count, the reason why I'm still so bearish is because of how these counts are hitting these certain extensions and hitting these certain retracements. A wave 3 should have broken out all the way to this extension minimally. But because we're in a bear market, this still is a a balanced market. Like we're moving sideways. It's not quite impulsive. So if we were in a true impulse market, we would have broken above the supply and we would have been running off to the races, but we didn't. So this is a shallow wave three. And so that's why everyone's like, wind moon. I'm like, it's not happening now, just because of where these extensions are hitting. Those are giving me that kind of inclination of, there's still more that's going on. And so wave three is typically 161.8% of wave one. And so when you look at where this extension is drawn, we drew it from the bottom. Oh, I actually may have misdone this. So this is the bottom of wave one. Ooh, embarrassed. So let's slap. Oh, dang! My whole theory ruined in one video. Just kidding. But and so we hit 161.8% extension. I guess I was drawing it from the peak here to see how high this retracement would go from the peak of where we drew down from here to the bottom of wave one. So if we're drawing it from wave one, or sorry, from the bottom of wave one, we're going to have a 161.8% extension here. So I was looking at something different. And so that's where we are getting these extensions from. And so you could be using these as levels to be, entering the market. If we have a clear defined path of a wave two, you could be using this retracement as a means of, dollar cost averaging or buying into a move with a preconceived idea that if this is a wave three that's happening, you now have a clear idea of where your profit levels could be taken. And so if we just draw this all the way over, I mean, we hit 123.6% right here and we fell. So I mean, you could have taken this as your exit, and you could have technically repositioned and bought back in at this 50% retracement, or you could have used it as an opportunity to dollar cost average higher, which I typically don't recommend. I only like to dollar cost average down. And you could have used the break of this as, hey, this is a signal that we're going to be going up to the next fib. And you might say that's not a whole lot of meat on the bone, but I mean, we're talking like 10%. And so if you were given an opportunity to make 10%, typically you're going to take it. I mean, don't get me wrong, like 10% doesn't sound as sexy as 100 or some of these other ones. But when you start taking more confident trades in a more consistent and pre planned manner, that compound is going to be happening a lot quicker than you think. And the biggest thing that I want you guys to kind of like take away from this is, one, Elliott Wave is a roadmap. It's a way for us to kind of figure out where the market is moving, how it's moving, and where we can be taking advantage of, certain price swings within the market. And so when we're looking at wave four, you'll notice that these are much shallower numbers. Wave four is, 14.6 or 23.6 or even 38.2% of wave three. So just by looking at this number alone, you can tell that when we're looking at the wave count, wave two is a much sharper retracement because this was the first relief rally out of like a corrective wave. So there's always going to be profit taking. But typically, if you can map where a macro corrective wave is ending, you wait and let this wave one happen. And I've timed my investments to get in on a wave two. And that's literally how I've balanced my portfolio like over the last few years is just I've been entering in during a macro impulse wave two and just let this ride all the way up. And this takes a long time. I mean, this doesn't happen, overnight. Like if we were to take a look at just, US equities, you guys have probably heard me talk about ES. This is SPY futures. And if we're taking a look at the macro view of it, this is where I got into, my investments during COVID. I got in down here at this wave two retracement. We had our 1, 2, 3, 4, 5 impulse wave up to make a super cycle of wave one. We had our A, B, C corrective flat for down here, making our wave two. And then we had our wave three pop. And this is where, we broke the previous all-time highs. Like this was our all-time high before COVID happened. This was the peak of the market. And we broke it with strength. But once people realized we broke it with strength, okay, it's time to accumulate. So we get these really weird wonky wave fours. And so the wave four, it's a 0.23.6% retracement. And this is exactly where we pivoted and we launched into this ridiculously extended minor wave three or intermediate wave three. And so my thoughts on the market is this is where my wave one, we'll just call it an intermediate wave one, intermediate wave two, incredibly extended wave three. And now we're heading into a very complicated wave four, which looks to have ended. This is a very impulsive looking structure that is happening in, US equities as a whole. And so our wave five isn't done. We still have one last leg in this market before we actually start to correct into a very deep bear market. So I'm still holding all my positions. Like I never cleared out my investment up here. Instead, I just used it and sold credit spreads. We'll go over that in another lesson. But this is how you can really time and predict where measured moves and movements are going to be happening in the market, and use that to really compound and capitalize on your return of investments. So we're going to go back to this. I know I squirreled a little bit. Um, and so, wave four, it's typically a very shallow retracement. And so we went over that, this is a much larger wave four retracement, but we've seen where it can be shallow. So wave two is typically a much sharper retracement. This time it wasn't. And so that really caught me off guard. I didn't trust it. I thought we would go a little bit more. But when we broke this, I actually DCA'd higher because I had my confidence. I was like, okay, we broke the high of wave one, we are for sure going to be going into an impulsive structure. I mean, sure, I missed out on a lot of this. I wasn't fully invested down here because I was terrified. Like, how low can we go? I mean, if you're looking at this chart and you're seeing that on a daily time frame, we are having moves go from negative 10% on ES futures. That's a lot. That's 292 points in a given day. So if you're holding one share, you're down 200 bucks. And then we pop up, 12% the day after for 324 points. That is insane. These are massive whipsaws. But you guys remember, I talk about dojis a lot. And this was a really big key factor in a doji. This was super bearish. And so the next day when this popped, I mean, options chains for going absolutely crazy. So you really need to like get a good read on like the candlesticks and where they're happening and how price is happening within the market. And that way you'll be able to more clearly dictate that this is the bottom of an impulse wave, because this is clearly an impulsive structure. I mean, the Fed announced, even Donnie announced that this is like I remember the quote exactly. He said the stock market is going to go up like a spaceship. And that's because the Federal Reserve was planning on spending trillions of dollars to be supporting the US equities market. And they sure as shit did. Like, we went all the way up to a high of 4809 from a bottom of, whoa, even more, a bottom of 2174. So, Elliott Wave is definitely a good way to, measure things and figure out where these pivots are happening. So when they say wave five is typically an inverse of wave four or equal to wave one, this is where it gets a little complicated because of their verbiage. So what they're essentially saying is it's going to be 123.6 or 161.8% of the peak of wave four drawn to the bottom of wave one. Or if you want to play it safe, you could just measure it from wave one to wave three, and you should be seeing a 61.8% retracement, extension based off of that number. And so we're going to dive into a little bit more about motive waves. So these are the waves we all want to see. We love, love, love motive waves because this is where everything's popping. I mean, everything's popping. Like the market is moving beautifully. There's a clear sign in uptrend. There's a very clear indication when it's an impulse wave. And so for impulse waves, we went over this. It's a macro 1, 2, 3, 4, 5 count, and there's sub counts within it for you to be able to create this macro wave one. And so when we're looking at impulse waves, again, they subdivide into 5 waves. So this wave one is subdivided between 5 waves. In figure two, the impulse move is subdivided by a 1, 2, 3, 4, 5 in a minor degree. So these are minor counts. And wave 1, 3, and 5 are also subdivided by impulse waves. So we have a 1, 2, 3, 4, 5, 5 counts subdivided, wave 3, 1, 2, 3, 4, 5 subdivided. So we have 5 counts to make a wave 5. And there are rules. So in order for you to clearly define what type of impulse or what kind of count this is, wave 2 cannot retrace more than the beginning of wave 1. So wave 2 can't go below 88.6 because the next fib below that is 100%. And so it can go to it, but it can't touch it. So we can go a little bit below 88.6, but it's not ideal because it creates a really ugly count, and it can't go below wave 1. So this wave 2 cannot go below this 0 point right here. Otherwise, it's not an impulse wave. And wave 3 cannot be the shortest wave. So there's these impulse waves, 1, 3, and 5. 1, it doesn't have to be the smallest, but it's typical when it is. And so when you see this wave 3, I mean, look at the size of it compared to wave 1. So wave 3 is typically the largest impulse wave. It's the Mac Daddy of them all. Sometimes wave 5 can be, but wave 3 just can't be the smallest. So if this is, let's say, from here to a previous wave, that this is 123.6%, well, this needs to be 161.8% minimum drawn from here to here. So wave 3 can't be the smallest. And wave 4 does not overlap the territory of wave 1. So wave 4 cannot dip below this wave 1 level here. Otherwise, we're not in a clear impulsive structure, and this is a wave 5, and that was the top. So if wave 4 goes below wave 1, it's over. I mean, this was a corrective wave, and we're going to be going much deeper. And wave 5 needs to end with a momentum divergence, meaning this has got to be a very, very fast wave. So wave 1 can't be the largest, wave 3 can't be the smallest, and wave 5 has to end with just a ridiculous amount of momentum. And if we take a look at Bitcoin, for example, where'd you go, girl? Oh, Lord. So when we're taking a look at wave 3, this is a bit of a janky structure. This is an ending with an impulse. Like, or it's an impulse that's ending, but it looks nothing like this. I mean, this took days of whipsawing, channeling within this ABCDE pattern for the wave to finish. And so if we've learned anything, it needs to end with a momentum divergence. So wave 5 did exactly that. I mean, we had a massive momentum divergence before we finished the wave. And then that is when we created the corrective wave afterwards. So wave 5 has got to look something like this, a really fast, sharp pattern. I mean, this happened within a span of, oh no, wrong tool, date range. So this happened within 42 days. And if we're looking at wave 1, I mean, this was a much longer period of time from wave 4. So, I mean, if we're drawing it from the bottom of wave 4, it happened within 77 days. So this type of measured move happened in a much shorter time frame, and it's clearly much more bullish looking. So that's what marked the wave 5. Like, this is where I actually exited like around here. I thought I miscalculated and we just didn't tap it. So I missed out on little gains, but it's fine. And these are like the bottom line is these rules, they really do work, and you can see them happening within a chart, something that we're all familiar with. And we kind of went over the fib relationship between these. Wave 2 is anywhere from 50% to 88.6, forget you, and it's measured from the previous move. So in order to get wave 2's retracement, you're measuring from the bottom of wave 1 to the peak of it. In order to get wave 3, you're drawing from the top of wave 1 down to the bottom of wave 2. So let's just say, for example, let's go back to Sol. I know I'm going to be going over a lot, and I'm sure there's questions. I mean, if there's anything that anyone has, I mean, just feel free to ask. It's totally fine if you interrupt. So, for example, this is probably going to be the peak of wave 1, and we're drawing it to wave 2. And so we're going to get our retracement, and we're going to be drawing it from all the way down here to the bottom of wave 2. It's not that big, but when you're, oh, so sorry, wave 3, yeah, it's drawn from wave 1 down to wave 2. So we're drawing it from the top here down here. So we should be seeing a much larger extension happening on this one, and we do. I think this one went up to like 300. Yeah, it went to something pretty crazy. So this doubled and if we go to a 4 hour, you'll see that we didn't close above the fib. We can wick above it, but as long as we close above it, it's being respected. So we're going to go back to that. So, I mean, wave 3 had a massive extension. I mean, right here, it just said that wave 3 is typically 161, 200, 261, or 323% of wave 1 and 2. Here we hit 300. So these are more guidelines. Um, this is the range you can expect fibs to take place. So when someone asks me, how far can we retrace? I'm like, we just need more data because over here, we tapped 50%, and yeah, we could pivot here, but this doesn't align with what we're going to be going over in a little bit, and you'll see why. Um, and wave four, so really quick, just to cap, wave one, you're waiting for that wave two to be respected. In order to figure out if you're in a wave three, we need to break the high of wave one. And so when that breaks, that's your signal. Like that is a clear, confirmed signal that we're in a pulse wave, and you don't have to take the risk of getting down here. But when we break above that, we're in a wave three. And wave four can't dip back down below wave one. So wave two is going to be the sharpest correction. It's going to be the most obvious. It's a very sharp retracement. I mean, more often than not, um, we're going to just zoom. Let me find it on this one, actually. And if this is hard to keep up, guys, I do apologize. I had 30 minutes for it. So this is where this got me a little bit, because this isn't a sharp correction. This looks more like a wave four type of correction. But wave two typically looks something like this. Like this is wave one, then this is wave two, because it's a very sharp corrective pull. And if we drew it from the bottom to the top, we're going to slap some fibs on it. Ooh. Oh. So typically, we're supposed to go much deeper than this. Like 38.2, it's very shallow. But I mean, Fed money was doing crazy things and just pumping the market. But typically, a wave two would have fallen anywhere from this range. Like that would have been ideal. So when you're looking at a wave two, it's anywhere from 50% to 61 or 88.6 of wave one. And wave four, we're going to spend a good amount of time on this because this is where shit gets complicated. Wave four is arguably the most confusing wave you'll ever count. Wave three is the most obvious wave you can count, and wave two is where you should be entering your position. There are three different ways to measure wave five. Um, we kind of went over this. Wave five is an inverse, so meaning it's an extension, like we're drawing it from top to bottom of 123.6 through 161.8 from a retracement of wave four, meaning you're taking your measurement tool and drawing it from the top of wave three to the bottom of wave four. And that's how you'll get these inversions. The second way to do it is wave five is equal to wave one. I don't use this method because it's complicated and it's just not my thing. The third way is it is 61.8% of wave one through three. So you're drawing it from wave one to wave three, and then you're actually drawing the tool back down. It's called an extension tool. I don't use either of these methods. I just use the inverse method because it's the easiest. So instead of complicating things and using this extension tool and drawing from the bottom here and trying to align it with something like this, like trying to get to the bottom of it, this is what that extension would have been versus just taking the retracement tool and just drawing it from the bottom. It's a much different method to do it, and it's just a lot more accurate, in my opinion. So I always use the inverse method when drawing fibs. And, there's different ways. Like their impulses can end with extensions. And this is where it gets a little complicated because you can have these, much larger legs happening within these. So there's just different models and different ways to look at it. That's why when we looked at this ES chart, this wave three count was so massive because it was an incredibly extended wave three count. It was a it was a third wave extension. So it looked something like this. They could end in different methods, like a leading diagonal. I mean, we saw something like this on BTC when we were looking at where'd it go? So this wave three count, it ended in a leading diagonal, meaning we had our wave three and our wave four, but we popped up a little bit higher in creating this leading diagonal pattern, which is what ended the end of this subdivided wave five of this macro wave three. So it does get a little complicated. But you just have to make sure that you're just literally reading these word for word of what they are. So it's a special type of motive wave with which appears as a subdivide of wave one in an impulse or subdivide of wave A in a zigzag, meaning this is a zigzag. We have our trend lines. We're counting these one, two, three, four, five patterns to make a one, A, B, C down to make a two, one, two, three, four, five to make a three, A, B, C to make a four, one, two, three, four, five to mark the end of wave one. So there can be these really complicated leading diagonal structures within the market, but they are easy to spot. It's just prices and a little bit imbalance when this is happening. And when it finally gives, you're going to have your massive wave three afterwards. Or if it's a end of, like, let's say a wave five, this is the end, but that ABC can be correcting up before it just comes crashing back down. So when you see these diagonal patterns, it spells trouble. Like, there's a big move happening one way or another. And if it's at the end of a count like this, like if we have a clear 1, 2, 3, 4, 5, or sorry, a 1, 2, 3, 4 count, and we see this leading diagonal, I mean, you can bet that there's going to be a big washout happening afterwards. But if this type of pattern happened at a wave one, wave three is going to be explosive because you still have another four counts happening afterwards. Someone have a question? No? Okay. And so wave three looks something like this. It was an ending diagonal where we had that 1, 2, 3, 4, and then with this count within it to mark the end of it. Same thing could be said in a corrective wave. If we're in a corrective market and we're getting our ABC move up and we have this ending diagonal pattern in here, it's easy to spot, but it does get complicated when you're reading all this. So, I mean, we're not going to go into details of this because, we've got like 20 minutes, but these are some of the motive sequences that we were going over. Like, waves have personalities. And so the personality of wave one and two, this is going to be the top of wave one. So wave two can't go below the 0 point. And wave three is in its initial stages, but you get your confirmation when it breaks the top of wave one. So if you're short and you're shorting this move down, you don't want to let this move happen against you. I mean, this is why wave three is so explosive, because when shorts enter the market, they're borrowing shares with the intent of selling them back at a lower level and actually capturing that return on the negative move down. So when a wave three happens, it's typically a very impulsive bullish wave because all of these stops are getting hit. All of these short orders are getting hit because they're getting liquidated. Sure, you guys are familiar with liquidation. They're using margin of some kind and they have limits and they can't go past them. So a lot of guys who are short, they'll be taking their profits and they're going to take their final stop at the top of an impulse wave. So when that breaks, the impulse of wave three is going to rocket. And there's typically gaps, but because crypto's 24 hours, there's really no gaps. With ES, same thing. It doesn't trade 24 hours. It trades something like, it's 5 days a week, but I won't go into the details, but it is a little bit complicated. So when we're looking at SPY, there's opening and closings. And so when we saw the end of this wave four here, there is gaps on gaps on gaps. So this is a clear sign that we're about to be entering a wave three. Like, there are gaps just leading all the way up. And once we finally had our break, it was just it was a little choppy, but you know what I mean. Like, we had a clear, smooth sailing trend that this baby was going to keep going up and up and up. So when they say gaps, they're referring to gaps within the candles of the open and closes. This is only specific to charts that trade, if I'm Pacific time, it trades from 6:30 in the morning until 1 p.m. And so anything that happens between then, the market's going to open at a different spot than when it closed sometimes. And sometimes there's a really big imbalance in between them. And so that's what a gap is. This was the close, yesterday. This was the opening today. So that's a gap, just in case you need a little clarification on it. And so it is the most powerful. It's the largest wave. Like, it's undeniable that we're in a wave three because it is just so explosive. And this is kind of back to that Venn diagram that I was talking about, that wave two typically has a vicious sell off. And wave four, it's a profit taking decline. It's not necessarily a vicious sell off. Um, in Bitcoin's case, that was a little different just because there's such a finite supply that it's really easy to move the market. But I mean, this was there was some stabilization before the flush, but then we can have those accumulation phases that are happening. This is that ending diagonal. We had that A, B, C, D, E, and then we just exploded. And then when we broke the high here, we had another explosive move. And this is the ending of that move. And so these are where these diagonals are kind of coming from. Like these are really the only trend patterns I care about is if I'm, looking at it in terms of Elliott wave versus just, this is a bull flag, this is a bear flag, those types of things. So wave fours can be complicated. We can look at Sol as like a most recent example. Um, because this was a tricky one. It's not your typical ABC count. It was a WXY. We'll kind of go over that. But, there's no real impulse structure to this. Like, we're not breaking higher highs. We didn't break the high over here of wave three. So it was clear that this was going to be coming back down. And this was a much deeper retracement than expected. But I mean, from the bottom of W to the top of X, we had an 88.6% retracement. But there was a minor demand here too. So a lot of times, big banks or people who are scared, they're exiting here. But when you see this giant wick happening, I mean, it was respected. Bots started to buy into this. Algorithms started to buy in this. People who read Elliott Wave and use fibs bought into this. And then you have the chasers. People are like, oh my gosh, we're reversing. And then you get people who are buying into it. So if this was a wave one, this was a wave two, the break of this would have been the wave three. You see how that kind of works? And this is almost like a diagonal in some way, shape, or form. But I just didn't care to draw it. And wave five, there's no diagram, which is so sad. But this is the final leg. This is the last dominant trend in the market. It's directional. They have to end with an impulse. The we'll read it. The news is almost universally positive. Everyone's bullish. So when Bitcoin was getting back to its highs, I mean, you guys can almost probably go back on Twitter and take a look at what influencers and people were saying when we were breaking back above this. How many people were like, "Oh my gosh, new highs!" Like Twitter was losing its shit. But you know, if you slap an extension on here, you can kind of have a better guess of like, hey, this was a clear 1, 2, 3, 4 count. This is five. This count's about to end. And so when we had this minor pullback before it, this is a wave four count. And look how nasty that looks. There's no direction, price is in balance, but it's whipsawing. There's inside candles with some slight outside. Then there's those candles that are retracing inside of this one. Like, it's a mess. Wave fours are a mess. Wave twos, oh no. Wave two's much simpler. Just a clear, sharp drawdown, and then it's over. But wave four can be so complicated. It's obnoxious. It really is. You guys will hear how much I hate wave fours. But this is the money grab. This is the cash grab. Wave five is when all the big money's exiting and they dump on the investors like you and I. So wave fives are the trickiest. They typically end in a really big impulse because everyone's buying in. They're buying on the new high break of wave three, which everyone just sees as a previous all-time high or a swing high pivot. You'll see a lot of retail traders like talking about that and like how exciting it is. But typically, what happens afterwards, there's a fall. Like depending on where we are in the count, like if we're breaking a new high, that typically means a wave three happened and we're in a wave five and it's about to end. So this is where everyone's pumping their bags, everyone's tweeting about it, everyone's talking to you about it, and then this happens. So this is just a little bit of an idea of how you can be, reading price action a little different, like counting waves and seeing if you can see them within themselves. But you can use, these tools, all of these measurements, all of these figures, all these diagrams, all these rules, the fib relationship between them, like these are incredibly helpful. Like this is really your Bible. Like if you're in an impulse wave, like this is your Bible. Like that is the best place you could read and figure things out to figure out where we're at in the market. Um, so wave five is the cash grab. Waves A, B, and C. So wave A, it's a correction. They're very hard. Not typically, they're very hard to identify. So impulse waves are super, super easy to pick. Like they're very easy to count. They're very easy to spot. It's one of those like, well, no, duh, this is impulsive. But then when you get up here, you're like, is that corrective? Like, I mean, we had a drawdown, but it's a little messy. Like, I can't tell. Oh, it ended, or like, no, not it ended. We popped. Like, okay, that wasn't corrective. Like, we're still good to go. And then this starts happening, and then this giant liquidation sell happens. So corrective waves are very, very tricky. Um, most analysts see the drop as a correction, but the bull market's still intact. So you'll see Kramer, people on the news talking how like, oh, it's just a correction, like it's not big, but they're not seeing the bigger overlaying picture that hey, this impulse structure is completely done. Like this is where the bull market ends, and this is where the bear market begins. People were a little bit quicker to jump on the bandwagon when BTC was over, just because there's a lot of like crypto haters, like big news outlets and things like that. They hate crypto. They really do. So whenever it's bullish news, they're talking about it a little jokingly. When it's corrective, they're talking about it a little grinningly. You could take a look. So wave A corrections, they're hard to identify because you can't really figure out if this was the end, if is the bull market still intact. But there's some technical indicators that accompany wave A, including increased volume, rising implied volatility. So when we start seeing, let's see if this volume shows an uptick. So, I mean, if we were to put a trend line on this is the top. I mean, we have a clear uptrend of volume hitting higher highs with a sharp liquidation coming and just, corrective price action. So, when you see price action that is moving up while volume is declining, that's typically not good. That's the end of a major, 1, 3, or 5 cycle, and there's going to be a correction that happens afterwards. So, there you really want to take a look at the rising implied volatility. That's a big one. Like this is volatile. Like we're having massive spike downs. Like volatility, like we're trading like crazy up here before we had that final shot up. And then we had this massive liquidation happening afterwards. This is what volatility looks like. Especially if it looks a little indecisive and a little, indirectional. Like that's the sign that something's about to change. Um, Wave B, this is kind of a son of a bitch, if you pardon my French, because the price reverse is higher. So when we're looking at personalities, we have our drop down in wave A. And this, I call wave B like the hopium wave. Like this is giving people hope that, the market's about to turn and, things are about to get back to normal. And then it just slaps you in the face. So wave B is that like false relief rally. It's same could be said for the inverse of wave two. It's like okay, like things are going to come back down. Like I didn't miss my entry, thank God. And then it just slaps you across the face with a wave three. So wave two and wave B are depending on what side of the tape you're on, it's either a blessing or a curse. Um, so wave B price reverses higher. If we took a look at that chart, wave A comes down, wave B goes up, and wave C finishes typically with strength. Um, so you may see some resemblance to that. This is now where price is reversing. It's going to be going back higher, but really there's no improving in price. Price is typically trending sideways. There's not a clear if this was a wave one and this was a wave two, well this should have been a wave three and we should have broken the high, but we didn't. So that is a clear sign that it's a corrective wave that's currently happening. So just pay attention to those rules. If you see a pivot high and you see a swing low, and that next move that looks impulsive, because that looks pretty sexy if you ask me, like that is a giant candle. That happened in one day. So price moved, holy shit, it moved like 18, 19% in one day. I mean, that would have me thinking, oh my gosh, we're in a wave three. Like, maybe this isn't a wave five count. Like I messed up, but then we didn't break the high. And then we get in this corrective pattern. It's like, okay, this should have been one, two, and three, then four and five, but it wasn't. And this is where those ending diagonals kind of come in handy. So wave B false hopium wave, you want to look for signs of clear dominant direction if you think this is an impulse wave. But if you don't, and you don't see that dominance, it's a wave B count and it doesn't break swing highs. It may after the fact, but the fact that that structure didn't happen when it should have is a clear sign that we're in a corrective wave. And wave C, this is the bitch. Price moves impulsively lower in 5 waves. Volumes increasing, and by the third leg of wave C, if we're doing a 1, 2, 3, 4, 5 count wave down, almost everyone realizes that it's a bear market and they're firmly entrenched. Like, how many people do you know that are down like 50, 60, 70%? And they're like, nope, I am stuck in my ways, and that's it. And then wave C hits them and they're like, my god, I'm down 80, 90%. Like, this is it. Like, like, I'm done with this. Like, how many people have you seen tapping out, in the market here? Like, that's a clear sign that this is almost done. So when I see people that are about to give up, I talk them out of it because I'm like, this is not the time for you to give up, because this is about to end. Like, this is the end of it. This is what the market does. This is what a giant wave C correction does to people. It makes them give up hope. And that's how that wave C is so impulsive on the way down. Um, so if you guys see one who's having a hard time, give them a good pep talk. It's not the end of the world, and now that you know a little bit about this, dude, just send them here. Have them read all of this shit. I guarantee you it'll help them improve. So we went over, impulse waves, what the profile is of a wave 1 through 5. We went over kind of the profile and the personality of ABC. And here's the bane of my existence: corrective waves. This typically happens in wave 4s. Um, by definition, a corrective wave is waves that move against the trend of one greater degree. Corrective wave have Corrective waves have a lot more variety and less clearly identifiable compared to impulse waves. No shit. Because if you look at how some of these are counted, it's going to boggle your mind. Um, these types of corrective waves, sorry, I'm about to sneeze. No? Okay, we're going away. These types of corrective waves are a real pain in the ass. They trick you. They make you think things are over. They make you question your count. And you're like, did I count this wrong? Like, a zigzag is typically the clearest and easiest one to count because you have a 1, 2, 3. You have a subdivided wave 5 to make a subdivided ABC to make B, and a subdivided 1 through 5 to make C. Super easy, right? Um, there's but there's 5 different types of corrective patterns. There's the zigzag, which is that 5, 3, 5. So 5 subdivision, 5, 3 subdivision, 1, 2, 3, 5 subdivision, 1, 2, 3, 4, 5. Zigzags are super sexy. I love zigzags. Flats, they're a little bit different. Triangles are a real pain in the ass. Double 3, triple 3, dude, forget it. I just stopped counting. Like, it's just let me know when the wave is over and I'll take a look. So zigzags, we went over it. It's a corrective 3 wave structure, ABC, 3 waves, and it's labeled as an ABC. There's that subdivision of way in C. We won't go over this because I literally just went over it. And there's the fib relationship. Like, each of these corrections are going to give you a structure, like what type of subdivision it is. 5, 5, 3, 5, 3, 3, 5, 3, 3, 3, 3, 3, and each of them are given fib relationships. So if this is wave A, this is the starting point, and this is the bottom. Wave B is going to be either 50 or 88.6% of wave A. So you're just drawing from the top to the bottom, and you're going to get your, anywhere from 50, 61, 78.6, or 88.6 for wave B. And that's how you can figure out where, you could probably get in on a little relief rally here. Like, if you're buying a dip on A, I don't recommend trading corrective waves because they're very, very shitty. But you could, know that, well, from the from the top to the bottom here, there's a chance that you could be getting a 50, 88% retracement on this pop going back up. And wave C is a 61.8, 100% retracement. See how we're breaking that low? If this was an impulse wave, this was going to be wave 1, this was going to be wave 2, but if we break below A, it's not going to be, or sorry, if we're breaking below this, this isn't going to be a one, and this sure shit isn't going to be a two. This is going to be an ABC move down because the fib relationship is telling you that it's going to be a 61, 100, or 123.6% retracement of wave A. So you're going to be drawing that fib from the bottom of wave A to the top of wave B. So this 1, 2, 3, 4, 5 sub count to make wave C is going to land you anywhere from 61 to 100 or 123.6% of wave A. If, and then there's the if wave C equals 161% of wave A, so meaning if you draw your fib retracement from the bottom of wave A to the top of wave B and it breaks below 123.6%, you may be having an impulse wave to the downside, meaning it's going to be an extension. That this is probably more of a 1, 2, 3, 4 count, and this there's going to be a sub 1, 2, 3, 4, 5 count again to make wave C. So it can be a real bitch if we break below 123.6% because that's when you get these like diagonals and things like that. But it wouldn't be this way. It would be going to the downside. Like if I was to reverse the way this looked, we would be seeing something like this. We had our, if this was going down, actually, I think I could just minus. Did it work? No. Oh, for God's sakes, forget it. You can inverse your charts. I forget if you put the minus behind it or in front of it. Yeah, it doesn't want me to do that. Forget it. Imagine if this was upside down. You would have you'd be thinking that, okay, this is, let's say it's 123.6% right here, to mark the bottom of our ABC count, and we broke above it. Then you're going to have a whole other 1, 2, 3, 4, 5 count to make the bottom of wave C. That's what I was trying to get at. TradingView had other things in mind. Um, and so that's a zigzag. That's a 5-3-5 structure. Oh, Lord. Get rid of it. And then you have flats. Flats are going to be subdivisions of, it's a 3-3-5, I think. Yeah, 3-3-5, meaning you're going to have your A, B, and C, but they decided it would be fun to make it a WXY count and a WXY count and a 1, 2, 3, 4, 5 count. Don't know why, but instead of making it A, B, C or something like that, they threw a whole another letter of the alphabet in here. But a flat correction is 3 waves corrected, still the same 3 as this, but just marked differently, and they can end a little differently. Like you can tell that this structure is a clear, there's a much clearer structure to this versus it looking like this. And so it's labeled ABC, although the labeling is the same flat, it differs from the zigzag. So this is a flat, and above was a zigzag. And the subdivision of wave A, whereas zigzag is a 5-3-5, a flat is a 3-3-5. So you have that WXY, WXY, 1, 2, 3, 4, 5. A corrective 3 waves move is labeled as ABC. It's always going to be, but there's going to be different subdivisions. Subdivision of wave A and B is in 3 waves. So meaning A and B is going to be measured in 3 waves. You can kind of catch these ahead of time. So for example, well, I don't know if I can find one. Like for example here, this could be WX, no, this is the bottom, WXY. That could have been a 3-wave count, but then you have this little cliffhanger, so it doesn't work. Let me see if I can find one. Or better yet, we're going to use a diagram. um, so this is where instead of having a clear like 1, 2, 3, 4, 5 count doesn't happen, you only see one swing pivot low, one swing pivot high, and another swing pivot low. Like typically, I don't know flats are happening until we hit B. Like until we break above this neckline here, like the starting point, we break above that and we start to retrace, that's when I'm like, oh, son of a bitch, this is a flat. Versus it being a very clear, like, okay, we're definitely moving down. Okay, we're pivoting here. Okay, we're going back down. okay, we're for sure going back down. Like there's those kinds of moments where you just realize like what kind of count you're in is just what type of moves and waves that current count is giving you. And so sometimes it's going to be confusing. You'll have these one, two, threes, or you'll have the one, two, three, four, fives, and the one, two, threes up. So flats, I don't really identify them until we're around B. Just full transparency. Um, wave B. Okay, so for example, um, let's just start from the top. It's a corrective three waves. It's labeled ABC. The subdivision of wave A and wave B is in three waves. We just went over that. One, two, three, one, two, three. So A and B is labeled a subdivision of three waves because this is a 3-3-5 count. A subdivision of C is in five waves and it's impulsive and it's a diagonal. So meaning it's going to be that 1, 2, 3, 4, 5. So C is going to be a little bit dodgy. Like it's going to give you a much stronger impulsive wave down, and it's going to be diagonal because it has to have a 1, 2, 3, 4, 5 countdown. Because bulls are trying to stop the selling pressure, sellers are trying to keep up the selling pressure. It's a battle when you get to the end of the wave. Wave B terminates near the start of wave A. So, meaning if wave A was up here and wave B went above it, wave B is terminated because it can't go above that previous high. Wave C generally terminates slightly beyond the end of wave A. So, if this is wave A, wave C typically terminates itself right around the beginning of it. And this is where and wave C needs to have momentum divergence. So you're noticing a pattern. When a wave ends, it's explosive. Like you'll know for sure it's the end of a wave because you're going to have these violent moves. You're going to have these crazy pops happening. Like that's how you know that wave is ending. Same thing here. Like we had an explosive ending to this A, B, C, D, and then E just was incredibly explosive. We broke that trend line. It's done, and we're moving into wave C, an explosive move down. Um, and so fibs are really going to help you. Fibs are going to help you so much because if this flat, this 3-3-5 subdivision, wave B is typically 90% of it. So it's going to like 88.6. But if you look at this zigzag, wave B is typically 50, 61, 76, sorry, 78.6, that's not right, or 88.6. So when you start getting this impulse like a little bit higher and higher, there were some of you guys who were asking about Soul and how we hit 88.6% here. And when I was, I think it was George who was asking, like, if it goes beyond 88.6, like, does that mean like this isn't going to be technically corrective anymore? If we went above this and like really held, so if you go to a daily time frame, we wicked and closed below it. So you got to go back and forth between the time frames because on the 4 hour we broke above it, but we tapped that supply like on a dime and had a flat top and retraced. Um, so that's how you can kind of tell what type of pattern you're in, which is why I said um, when I'm counting, I typically don't know we're in a flat until we hit wave B, because sometimes I can kind of trick myself and be like, oh, I guess I could see a 1, 2, 3, 4, 5 down, or is this a WXY? You see what I'm saying? So when you wave B is going to be your tell, because if we're hitting these lower retracements and we're going down, you're like, okay, I know that this is going to end like really impulsive just from here on out. But if we go to, let's say, where'd it go? Oh no. Oh, 90% of wave A, this means that we're going to have a little crazy structure going down. But then this is a regular flat. So wave C, it can end at 61.8, 100%, or 123.6% of wave A and B. So you're measuring from wave A to the top of wave B to get these fib retracements. Okay, so it's 607. We got expanded flats, running flats, triangles. So I'll be able to get to the end of flats, but I won't have time to get into triangles or these double threes or these triple threes. So we can do a part two, or I can just hop in VC tomorrow around the same time and we can just finish it then. But let's finish where we're at. So we have expanded flats. So if you know anything about the subdivision, we have a zigzag, which is a 5, 3, 5. 1, 2, 3, 4, 5. ABC, 1, 2, 3, 4, 5. 3, 3, 5. WXY, WXY, 1, 2, 3, 4, 5. So we're in that 3, 3, 5 subdivision. So it's an expanded flat. Um, why is it an expanded flat? Well, a corrective three-wave move labeled as ABC, A, B, and C. A subdivision of wave A and B is in three waves. So wave A and wave B is a 1, 2, 3, 1, 2, 3. So it's WXY, WXY. They're going to be subdivided into three counts. And subdivision of wave C, this bitch, is five waves. It's impulsive, it's diagonal. You can see it has a sharp, sharp move down from wave 2 to wave 3. Um, the subdivision of wave A and wave B can be any corrective three. It could trick you out to be a zigzag, a flat, a double three, a triple three. Wave B of the 335, so wave B, 3, 3, 5, terminates beyond the starting point of wave A. So they cut it off, which doesn't make sense because they should have shown the high. So wave B is, you're noticing a pattern. Wave 2, so if we're looking at this diagram that gives it a lot clearer picture, wave 2 terminates at the bottom of wave 1. Like that means we're corrective. But if we inverse this image in our minds, and this is the start of wave A, and we go A, B, wave B terminates on the break. So if wave B is going above the starting point of wave A, it's an impulse wave. And if wave 2 breaks below the starting point of wave 1, it's a corrective wave. So those are the really, really easy rules to pay attention to help you figure out where you're at. So back to expanded flats. Um, we went over the subdivision is, the last wave, it's going to be impulsive. It's going to be explosive. The subdivision, I think we already went over that. Oh yeah, here we are. So wave C ends substantially beyond the level of wave A. So meaning this is wave A, that expanded flat goes well beyond it. Because on the regular flat, it goes 61, 100, or 123.6. So the only difference in the structure is the wave C is going to be going much lower. So wave B is typically 123.6% of wave A. So from the start to here, you're going to have 123.6. But wave C, it's going to be going 123.6 to 161.8. So when they said this wave C needs to have momentum divergence, and I may have read it wrong, but they were saying it may end in a diagonal. Could have read that someplace else. But if you see wave C keep going lower than wave A, you're typically going to have an expanded flat, especially if you're counting a 3 subdivision of wave A and wave B and a 1, 2, 3, 4, 5 count subdivision of wave C. Fancy word of just saying this is an expanded flat and it's going much lower. We're going, 123.6 to 161.8. And the last flat. So this is a running flat. Um, it's still going to be a 3 subdivision, wave A, WXY, 1, 2, 3, and B, 1, 2, 3, subdivision of 3, and wave C, subdivision of 5, 1, 2, 3, 4, 5. A corrective wave 3, it's labeled ABC. Subdivision of wave A in B is 3 waves. Subdivision of wave C is 5 waves. Impulse wave. Bam, bam, bam. Sorry, it's a long day. The subdivision of wave A and B, you're going to see a lot of repetitiveness in these guidelines, so pardon me for repeating myself. But you get the point. I'm going to ignore all this because we literally just said it. Wave B of the 335 subdivision 335 pattern terminates substantially beyond the starting point of wave A. So wave B, the starting point's here, it's going to terminate substantially beyond it, not just at the end of it. Why? Because wave B is 123.6% of wave A. So this is where these running flats get tricky. So if this is the starting point, wave B is going to be going to 123.6% of wave A. So it's going to fake you out, son of a gun. It's going to make you think this is an impulse wave because we're going 123.6% of the starting point. But then they trick you because you have a 3 count. So if this was an impulse wave, we would have a 1, 2, 3, 4, 5 count, not a subdivision of 3. So don't let these trick you. Those measured moves are important. The subdivisions are super important. They're going to tell you the tale of what kind of count you're in. Um, and wave C, lastly, this little fella, it's going to go anywhere from 61.8 to 100% of wave A and B. So you're measuring from the bottom of wave A, top of wave B, and this wave C is going to end on a 61.8% retracement or 100% retracement of wave A. And if it doesn't, well, you got an expanded flat because wave B can go to 123.6% of wave A. So if basically flats are like they're all the same thing, like they're all three. Where'd it go? Flats are all going to be 335s, but it just depends on how wave C ends. So that's the only difference between all of these flats. That's where it gets a little tricky, because you don't know where this could end. Like it can end at a 61% of wave A and B. It could end at 123.6%, or it could end at 161.8%. And they all have the same subdivision. So it's just where wave C ends depends on what flat you're in. So there's 3 kinds, and then triangles. If you guys are up for it, we can do same time tomorrow. I don't mind doing like a part 2 of this, just because there is a lot of Elliott wave, and if you guys are still here, chances are you wanted to learn and you still want to figure out a little bit more about it. Um, oh, Yozer, I'm so sorry I didn't see that. What market news should we be looking for to cause demand? Um, well, typically, he has a good question. So, what kind of news could we expect to be causing demand? I mean, honestly, the end of a corrective wave, the end of us, for example, during COVID, the end of it was the Federal Reserve was stepping in. They were going to bump trillions of liquidity into the market. That was the bottom signal. So it's big events that involve everybody. So it can't be an event that's minor and only affects a few parties. It has to be a big event that affects everybody, because what marked the end of, we're just going to go back to futures. Let's go weekly, because, for example, what ended this fun little party was the beginning of COVID. It was a clear 1, 2, 3, 4, 5 count, super sexy impulsive wave ending with a bang. COVID happened. A, B, C. Fed's gonna be pumping the market like there's no frickin' tomorrow. 1, 2, 3, 4. Crazy extension of wave 3. Crazy whipsaw action of wave 4. And now, signs of inflation are about to come to an end. So people are like, yay, it's a good time to buy. So it's little events like that. Not little, it's big events. It has to be an event that affects everybody. So those are the types of events that cause demand in the market. Does that answer your question?
Yeah, thanks, Cliff.
Oh, for sure. Um, so that's all the time I got for today. I wouldn't be surprised if I left you guys with more questions than answers. But really, read this. Like, read it over and over and over. Like, I studied this in like 8 hours. Like when I first learned Elliott Wave, and I just read it front to back 2 or 3 times before I started to implement it. And I just started, like, in order to like kind of help start counts. Like, you are looking for clear signs of a top and clear signs of a correction. You're looking for, like, luckily the market gave us such a freaking gift that you have a clear sign of when an impulse wave ended and a clear sign when a corrective wave ended. And now you have this big, giant, beautiful impulse wave that you can count and start practicing mapping where things are, mapping where fibs can be, how you can practice drawing them, how you can practice looking and identifying for those subdivided counts within the market. So ES futures is probably the best way for you guys to start. If you're counting Elliott wave and you want to get into this, do it on ES futures, because it runs technically like 24 hours. Whereas SPY has all of these like gaps, and the chart just doesn't look as sexy because it's only open like 8 hours a day. So there's a lot of choppiness that can kind of get you a little confused. And also Forex. Like Forex does a really good job of like supply and demand and Elliott wave count too. I haven't traded Forex in years, but because it's running 24 hours like this, there's not many gaps available. So anything that doesn't have a gap makes it a lot easier to count. So if you guys are looking to get started, read this. Read it, read it, read it, read it. Read it 2 or 3 times before you start looking and trying to count things and figure things out. And just know that you can always ask me. Like you can always pop in chat and be like, "Hey, Clutch, can you take a look at my count?" I'll be happy to go over it with you. If you want to do it in a DM, you want to do it in chat, like I'm perfectly fine either way. Um, I know Yoser and GOJ, like they ask me questions all the time about counts, and I've got no problem answering them. So just know that I'm always happy to help be a soundboard. Where if you guys want some help and you want some direction in this, dude, just ask. I'm more than happy to help walk you guys through it because it's complicated. But just know that that link I posted is a great, great Bible for Elliott Wave. And that's all the time I got for you guys today. So I genuinely hope you guys found some value in this. I hope it helped, answer some of the questions and kind of helped you guys figure out exactly how I map the market the way I do, how I quickly deny somebody saying, wins, it's all going to 69. I'm like, nope, not happening. Like the just the count's not there. Like it's not going to happen. So just little things like that. Like what gives me confidence is because I count. I know the measured moves. I know where we're at. And it's because I've studied this and I've implemented it for like the past few years now. So I've got a really good grasp on it. So if you guys need help, dude, just holler. Happy to help you guys. I just want that to be the ending note. I'm happy to help you. Don't feel like I'm bothering you. Or sorry, don't feel like you're bothering me. Ask away. All right. Well, I hope you guys have a great rest of your day. I'm gonna head on out. If you guys got any questions, hit me up in chat.
All right, man. Have a good one.
Thank you.
Cheers, you guys.
Yo, Denax, you there?